Hi, I'm Scott from Solace Financial. This is my weekly update for my clients, friends and family. The information in this video is not personal advice, and if you've got any questions, give me a call before doing anything. The share market, the Australian All Ordinary share market was up 1.3% last week. Fairly volatile week last week, a lot of ups and downs. The story I want to talk to you about this week is what we call PE ratios. PE ratios are a way to have a look at the value of a share or a stock to see if we believe that it's overvalued, undervalued compared to what their profit or earnings are. So the PE ratio is simply the price per share divided by the earnings per share, and the earnings per share is the net profit of the company divided by how many shares there are in the total company. So this is important because we're going through earnings month at the moment. Commonwealth Bank announced their net profit last Thursday of $7.3 billion. And while that sounds like a lot, that's down from $9 billion last year, and their share price is fairly similar to what it was last year. So that affects the PE ratio. So currently the share price of Commonwealth Bank is $74.34. This time last year it was $75, so very similar. 1 year ago, the earnings per share was $4.65 per share, and therefore the PE ratio of Commonwealth Bank was 15.98. Now, because the net profit has gone down and the same amount of shares on the market, the earnings per share has dropped to $4.12 per share, and therefore the PE ratio has gone up to 18.04. This is a chart showing the average of all of the PE ratios on the Australian stock market back since 1995. And generally what we see is the PE ratio goes between about 16 and 12 in Australia. So whenever it's above 16, generally the share price is fairly high compared to the earnings, and whenever it's below. You can see here in 2008 we saw the global financial crisis, which saw our stock market fall 50%, which brought down their PE ratio of the whole market. But then when the earnings came in, they were a lot lower as well. So therefore the ratio went back up to say that it was maybe a little bit overvalued at that stage. We went through a period of consolidation and working it all out. But now, since we've got COVID-19, we've just seen a huge spike in our PE ratio. And this is generally because the earnings of the companies are coming down while their share price is fairly similar to what they were this time last year. So we think that there's probably one or two things going to happen: either a share market pullback, a reduction to get that PE ratio back in line, or earnings are going to go up in the future. We probably think the second one, of earnings increases in the near future, is probably unlikely. There is also another thing that's going on at the moment, and that's called a theory of PE expansion, which means that more people are willing to accept a higher PE ratio because interest rates are low. Kind of, where else are you going to put your money? Are you going to put your money in bank accounts and fixed interest and earn next to 0% interest? Or will you accept that the share market's a little bit higher than what it was for the same amount of earnings? Really interesting times ahead, and it will be really interesting to see how all the earnings come out this month. Thank you very much, and I hope to do one again on Friday. Thanks.